Joining us now, Jeff DeGraff, chairman at Renaissance Macro. Mike Santoli also part of this conversation. Jeff, let's start with you. I mean, what do you make of the level of pullback? We did have a 10% pullback for the NASDAQ and the level of the bounce today, about 3%.
Yeah, look, I think it's all been pretty healthy, all things considered. I know a lot of people concern themselves with breadth. Most of the breadth measures that we see are still in very, very good shape. There is obviously concentration and outperformance. That's completely different than actually having breadth divergences. So I think you're in good shape there. Coming back to the 50-day, albeit it was swift, usually you'd expect to see that through a time consolidation, not price, but still very, very good news. You know, in terms of how we look at the world for the next 6 to 12 months, we still think we're fully engaged in this bull market.
So how do you square that sort of bullish view that you just gave us, longer-term bullish view, with some of the frothy elements out there, the overbuying, the stock splits, the mania, as Stan Druckenmiller said earlier on Squawk Box?
Well, look, I don't think Stan's wrong. I have great respect for Stan and what he's done. At the same time, I think you have to look at where we are in terms of the monetary cycle. You've got basically 100 basis points of negative real rates. So I think, you know, the Fed is hoping for inflation. I think they're getting it. They're getting it in asset prices. I don't think you've got full participation yet. Sure, you've got some areas of the market that are a little frothy and, you know, frankly needed to have a comeuppance, if you will. But all things considered, I think generally speaking, people are still relatively tentative. The data doesn't completely support what you're seeing in equities yet. I think that's good news, not bad news. You know, equities tend to lead the economic data. I think that's exactly what they're doing here.
Jeff, you've been looking a bit at the likely seasonality type effects, but do they and should they apply this year? I mean, they clearly didn't really apply in August, for example.
Well, it's a great question. Well, I've been doing this for 30 years, and I always feel like every year I'm saying this time is different for seasonality, and I look back in December and say, you know what, it wasn't different at all. So I think you have to be cognizant of what the seasonal trends are, and that would suggest there's probably a little bit more weakness through the remainder of this month. But all things considered, we're probably in pretty good shape for the fourth quarter to tack on not only what we make up what we just lost, but also go on to new highs as far as the seasonal trends are.
Mike, what sort of things will you be watching to confirm whether Jeff's right and that, you know, the bull trend resumes, despite the fact that, you know, some people are out there saying we still have this huge gulf between what the economy is telling us and what the market is telling us?
Yeah, I mean, I think that maybe the conduit between those two things, and I know Jeff watches this too, is just what's happening in the credit markets. Is there any stress right there? Is it supportive of the idea that the economy is in decent shape and you have good liquidity? That's one thing, but also the cyclical parts of the market, the ones that are geared to what the economy is actually doing, are they going to continue to hold up okay? Or in fact, is that maybe if we have a further pullback in the big secular growth stocks, does it sort of weigh on those as well? So to me, those are the indicators, and whatever kind of positioning sentiment adjustment we have in the interim, that stuff can potentially kind of rise to the surface as a tell.
I think Mike is absolutely right.
Sector?
You have to watch the credit markets. I'm sorry, you have to watch the credit markets here, and we do it on a sector by sector basis, and across the board, whether it's energy, which you'd expect to see some stress, you're still not seeing much stress in the energy credits. You don't see any stress in the financial credits. So you usually see that in a recession, and that just hasn't been the case here. So I think you're in a very good spot for credit, and I think that continues to get underappreciated and underestimated, the impact that has on assets.
Got it. Jeff DeGraff, thank you for joining us from Renaissance.